Hey everyone, welcome back to The Explainer. Today, we're diving into something that literally keeps the global economy from falling apart, and that is financial trust. I mean, think about it. What makes an investor confident enough to pour millions of dollars into a company? Or why on earth is a bank willing to lend massive sums of cash to a business that wants to expand? How do governments know they're actually collecting the right amount of taxes? Well, it all relies on a complex, highly structured system of verification. So today, we're demystifying the world of auditing and unpacking the exact mechanisms that keep our financial gears turning with absolute confidence.
Here is our roadmap for today. We'll quickly hit the need for audits, their nature and core objectives, the scope and limitations, assurance engagements, and finally, professional auditing standards. Let's get right into it. All right, part 1, the need for audits and how they build confidence. Think about the sheer scale of business today. You've got this massive web of people, shareholders, trade unions, insurance companies, and they all rely completely on financial statements. But here's the million-dollar question. How do we actually trust the numbers? If a company just hands you a spreadsheet claiming they made record profits, what's stopping them from just making it up? What gives all those different users the assurance they need to actually make diminished risk decisions with their money?
Now, you might think this is a purely modern corporate problem, right? Actually, no. The need for verified accounts is basically as old as civilization itself. There are literally references to auditing fixed accounting years and checking for financial abuse way back in the 4th century BC in Kautilya's Arthashastra in India. So yeah, this isn't just some new chore, it's a foundational pillar of human trade. In fact, if we look at the word itself, audit comes from the Latin word audiere, which literally translates to hear. Picture this. In medieval times, employees would literally stand there and read their accounts out loud, and auditors would just listen, making sure nobody was being careless or trying to pull a fast one. Of course, the Industrial Revolution blew up the volume of trade, so just hearing accounts read aloud wasn't going to cut it anymore. It had to evolve into the complex system we rely on today.
Moving on to Section 2, the nature and core objectives of the modern auditor.
So what actually is an audit today? Fundamentally, it's an independent examination of financial information done to express an opinion. And I really want to emphasize that word independent. That is the whole ballgame right there. The auditor's judgment absolutely cannot be subordinate to the wishes of the company they're auditing. That total independence is what allows them to act objectively, completely free from the creeping influence of bias.
Now it's vital we draw a clear boundary here, because people mess this up all the time. An audit is not a fraud investigation. They are completely different beasts. An audit has a very general, broad scope aimed at checking the overall health and fairness of the financials. An investigation is super narrow and specific, usually triggered because someone already suspects fraud. Plus, auditors aren't forensic detectives. They aren't experts in spotting forged documents, and they don't have police powers to search a building or interrogate witnesses under oath. So, what are the actual goals? Let's look at the objectives laid out in the auditing standards, specifically SA 200. The ultimate endgame here is to obtain what is called reasonable assurance, that the financial statements as a whole are free from material misstatement, and that applies whether the mistake was just an honest error or straight-up intentional fraud. Once they lock in that assurance, their objective is to express an opinion on whether those statements follow the proper financial framework, and then report those findings.
All right, Section 3, Audit Scope and Limitations, and understanding where the boundaries are.
When we talk about scope, an audit really has to cover all aspects of an entity that are relevant to its financials. It's not just a person squinting at a balance sheet at the end of the year. The auditor has to genuinely understand the business, test the internal controls, and gather enough evidence across the entire organization to reliably boost the confidence of the people who will actually use those statements. But, okay, here is the reality check. Notice I keep saying reasonable assurance. That's because an audit gives you a very high level of confidence, but it is absolutely never 100% absolute assurance. There is always going to be a small slice of unavoidable risk. An auditor is simply not expected to, and realistically cannot, reduce audit risk to absolute zero. Why not 100% certainty? Well, it boils down to inherent limitations. First off, the very nature of financial reporting involves a ton of subjective judgments and estimates by management. It is not an exact science. Second, the audit procedures themselves have practical and legal limits. Auditors can't possibly check every single transaction, and if management sets up a highly sophisticated, intentional fraud, it might just stay hidden. Therefore, absolute assurance is just practically impossible.
Which brings us to Section 4, Understanding Assurance Engagements.
So an audit is actually just one flavor of a broader category called an assurance engagement. This is basically any formal arrangement where a practitioner evaluates a subject matter against specific criteria and then gives a conclusion. The whole point here is to enhance user confidence, giving them the peace of mind that the chance of the info being wildly incorrect is significantly diminished.
But keep in mind, different engagements give you different levels of comfort. A full-blown audit gives you that high, reasonable assurance we've been talking about. But sometimes a company might just need a review of their statements. A review is a lot lighter. It involves way fewer procedures than a full audit, so it only provides a limited or moderate level of assurance. They are both super valuable, but they serve different needs and offer different guarantees.
And finally, Section 5, Professional Auditing Standards, the rules of the game.
To make sure all of this actually works, we have standards on auditing, or SAs. SA 200 is the foundational benchmark here. It establishes the overall objectives and dictates the auditor's broad responsibilities. Without these universal standards, the word audit could literally mean completely different things depending on who is doing it, and that would instantly destroy the very trust we've been talking about. These standards are, no joke, the glue holding the entire financial reporting system together. By making sure audits happen against established benchmarks, they improve the overall quality of financial reporting. They promote uniformity across the entire global profession, make sure accountants are equipped with the right skills, and ultimately guarantee the quality of the audit itself. So wrapping up this explainer, I want to leave you with a lingering thought. We've seen that because of the inherent realities of business and human nature, achieving 100% absolute assurance in financial statements is literally impossible. But considering the strict standards, the total independence of the practitioners, and the incredibly broad scope of what they check, is reasonable assurance enough for you? Is it enough to secure your trust when you invest, lend, or participate in the global economy? I'll let you ponder that balance between unavoidable risk and the immense value of an independent audit. Thanks for hanging out with me on The Explainer today, and keep questioning the mechanics of the world around you.